If you want to replace the paycheck from your job with income from your assets, you have to understand one basic principle first. A paycheck is not freedom. A paycheck is a transaction. You give your time, your energy, your attention, and often the best years of your life to an employer or a business. And in exchange, money arrives. That system can work, it can feed a family, it can build a career, it can create stability, but it has one weakness that people do not like to look at directly. The income stops when you stop. That is the core problem. If you make $80,000 a year from your work and you want to stop depending on that work, then you need your assets to produce something close to $80,000 a year for you. That sounds simple, but most people never think about it that way. They think about wealth as a number on a screen. They think about retirement as a pile of money. They think if I can just get my account to a certain balance, I will be free. But freedom is not only about the size of the account. Freedom is about the relationship between your assets and your expenses. If your life costs $80,000 a year, then the question is not just, how much do I have? The question is, how much reliable income can my assets produce without forcing me to sell them at the wrong time? That is the difference between having money and having a system. Most people are told a very simple story. Put money into the S&P 500, keep buying, let it compound. Do not touch it. In many ways, that is good advice. I have always believed that owning productive assets over long periods of time is one of the most reliable ways ordinary people can participate in the growth of capitalism. Broad stock market ownership can be an excellent core. But if the question is not just wealth accumulation, if the question is replacing a paycheck, then the problem changes. A stock index can build wealth, but it does not necessarily give you the monthly income you need to pay your bills. It can go up a lot over time, but it can also decline sharply at exactly the moment you need cash. So if your goal is income, you need to think in terms of cash flow, risk, taxes, liquidity, and effort. That is what most people miss. They think the choice is between working forever or finding one magic investment that pays them forever. That is not how the world works. There is no single perfect asset. Every asset has trade-offs. Every income stream has risk. Every form of yield comes from somewhere. The person who understands the trade-offs can build a balanced system. The person who does not understand the trade-offs usually chases the highest yield, buys the wrong thing, and learns the lesson at the worst possible time. So I want to walk you through the 5 types of assets that can create income. I will go from the simplest to the most difficult, because that is the way I think about building a system. You do not start with complexity, you start with clarity. And I want to be very direct about something. This is not easy. It will not happen overnight. It takes capital. It takes discipline, it takes sacrifice, it takes the ability to delay gratification. It also takes the humility to understand that income is not free. If someone promises you high income with no risk, the risk is probably hidden from you. The first place many people can start is with Treasury securities. When you buy a Treasury, you are lending money to the United States government. In exchange, the government agrees to pay you interest and return your principal when the obligation matures. The basic idea is simple. You provide capital, you receive interest, that interest can become part of your income stream. This is one of the simplest income mechanisms in the financial system. The reason many people start here is that treasuries are generally considered among the safest dollar-denominated assets in the world. The United States government has taxing authority. It has control over its currency. It has the Federal Reserve behind the financial system if the government could not meet its obligations. The consequences would reach far beyond your treasury holdings. The whole global system would be under stress. That does not mean there is no risk. It means the risk is different from the risk of owning a private company or a rental house or a small business. Treasuries also have a tax advantage that many people overlook. Interest from treasuries is generally exempt from state and local income taxes. It is still subject to federal tax, but if you live in a high-tax state, that distinction can matter. The cash flow you receive may be worth more after taxes than a similar rate in a bank account. You can buy treasuries directly, or you can use treasury-focused funds and ETFs that make the process easier. A short-term treasury ETF is one way some investors create monthly income without having to constantly manage individual maturities. The fund owns short-term government debt, collects interest, and distributes income. That sounds simple, and in many ways it is. But you have to understand what treasuries do and what they do not do. Treasuries are not designed to grow your principal in a dramatic way. If you lend $100, you receive interest on that $100. But the $100 itself is not becoming a productive business. It is not building factories. It is not selling software. It is not increasing its margins. It is a loan. So treasuries can produce income, But they are usually not the engine of major long-term wealth creation. That is the first trade-off. The second trade-off is that your return is tied to interest rates. When rates are higher, Treasury income can look attractive. When rates fall, the income falls if you build your whole life around a certain Treasury yield and that yield declines. Your income plan changes. That is why I do not think in terms of one asset, I think in terms of systems. Treasuries can be useful because they are relatively simple, liquid, and predictable. They can help create a base layer of income. They can provide stability. They can give you money that is not exposed to the earnings of one company or the maintenance problems of one property. But they also have limitations. They do not usually keep up with the kind of growth you can get from owning excellent businesses over long periods. If inflation is high, the real value of the interest can be smaller than it looks, and if you rely only on safe income, you may protect your principal while slowly losing purchasing power. That is a very important distinction. Many people confuse safety with preservation of buying power. They are not the same thing. A dollar can be safe in nominal terms and still become worth less in real terms. This is one of the great hidden mistakes in retirement planning. People protect the number and lose the value. So I would think about treasuries as one part of the machine, not the whole machine. The second category is dividend, paying ETFs. This is where you move from lending to ownership. When you own shares of a company, you own a claim on the profits of that company. If the company earns more money than it can intelligently reinvest, it may return some of that cash to shareholders through dividends. That dividend can become income to you. The appeal is easy to understand. Instead of only working for money, you own a piece of a machine that works for money. If the machine produces profits, and if management distributes part of those profits, you get paid. But there's a very big difference between a company that pays a dividend and a company that can safely keep paying it. This is where many income investors make mistakes. They see a high dividend yield and think the investment is better. In reality, a high yield can be a warning sign. It can mean the market expects the dividend to be cut. It can mean the stock price has fallen because the underlying business is deteriorating. It can mean you are being paid more because you are taking more risk. Yield is not income if the capital behind it collapses. That is why I prefer thinking in terms of quality, diversification, and durability. A dividend ETF can help with that because instead of relying on one company, you own a basket of companies. If one company weakens, the fund can reduce or remove it. If another company becomes stronger, the fund can include it. The system does some of the sorting for you. That does not eliminate risk. It reduces company-specific risk. One approach is to own dividend aristocrat-style companies, businesses that have a long record of paying and increasing dividends over many years. These companies tend to be mature, established, and disciplined. They are not usually the fastest growers, but many have survived different interest rate environments, recessions, inflation cycles, and competitive pressures. That kind of record matters because income investing is not just about today, it is about whether the income survives tomorrow. Another approach is broader dividend ETFs that focus on high-quality companies with stronger dividend yields. These funds can provide more income than a broad market index, while still giving you diversification across many businesses. Some investors use them as a middle layer between very safe income and more volatile growth assets. Then there are international dividend ETFs. This is important because most people are too concentrated in the country where they live. Americans often hold mostly American assets. Europeans often hold mostly European assets. People confuse familiarity with safety. But a country is also a risk factor. Different countries have different growth rates, interest rates, demographic trends, currencies, inflation patterns, tax rules, political risks, and market valuations. International dividend funds can give you exposure to companies outside your home country, and in some cases, those companies may pay higher dividends than similar companies in the United States. But again, there is a trade-off. International assets bring currency risk, they bring political risk, they bring accounting differences, they bring different shareholder cultures, they can help diversify your income, but they can also make the system more complex. That does not mean you avoid them. It means you size them properly and understand why they are in the portfolio. Then there are real estate-related ETFs, especially REITs. A REIT is a real estate investment trust. Instead of buying a property yourself, you can buy shares in companies that own real estate or real estate-related loans. Some REITs own apartments, some own warehouses, some own shopping centers, some own offices, some own data centers, some own medical buildings. Mortgage REITs are different because they own or finance real estate debt rather than owning the buildings themselves. This can produce income because real estate often produces rent, and REIT structures are designed to pass a lot of taxable income through to shareholders, but you must understand the asset underneath the yield. An apartment REIT is not the same thing as an office REIT. A warehouse REIT is not the same thing as a mortgage REIT. A low-quality property portfolio with a high yield can be much more dangerous than a lower-yielding portfolio with stronger tenants, better balance sheets, and more durable demand. This is a general rule for all income investing. Never buy the yield before you understand the source of the yield. If the yield comes from a stable business with good assets, prudent leverage, and consistent cash flow, that is one thing. If the yield comes from financial engineering, excessive debt, declining asset values, or a temporary spike in payout ratios, that is something else entirely. So dividend ETFs can be useful. They can create income. They can reduce the work of analyzing every company. They can diversify your income streams across many businesses and sectors, but they are still investments. They go down, dividends can be cut, funds can underperform. And if you buy blindly because a yield number looks good, you are not investing, you are reaching. The third category is real property. This is where the income conversation becomes much more serious because real estate is not just a financial asset, it is an operating asset. When you buy a rental property, you are not simply buying a line on a brokerage statement, you are buying land, walls, plumbing, tenants, leases, property taxes, insurance, repairs, legal responsibilities, and local market risk. You are also buying the possibility of cash flow, leverage, tax advantages, and long-term appreciation. That combination is why wealthy people have liked real estate for a very long time. A good rental property can pay you every month. The tenant pays rent, the rent pays the expenses. If the deal is structured correctly, there is money left over. That leftover money is your cash flow, but the words "if structured correctly" matter more than most people realize. Real estate can make you wealthy, but it can also quietly drain you if the numbers are wrong. Many people buy real estate because they like the property. That is not investing. Investing is buying the numbers. The property may look nice, the neighborhood may feel good, the story may be attractive. But the real question is, after taxes, insurance, maintenance, management, vacancies, financing costs, repairs, and reserves, what is left? That is what matters. If you collect $2,000 a month in rent, that does not mean you make $2,000 a month. You have expenses, you have property taxes, you have insurance, you have maintenance, you have vacancy, you may have management fees, you may have a mortgage. The roof will not last forever. The furnace will not last forever. The tenant may leave, the city may raise taxes, insurance may go up. A serious investor builds all of that into the analysis before buying. Let us use a simple example. Suppose you buy a property for $200,000. Suppose it rents for $2,000 a month. That is $24,000 a year in gross rent. But gross rent is not income. After expenses, maybe you have $10,000 left as net operating income. If you bought the property with cash for $200,000, that $10,000 is a 5% return before considering some other factors. Is that good? It depends. It depends on your alternatives, the risk, the location, the growth potential, the quality of the tenant base, and the amount of work required if your standard is a 7% cash return. Then $10,000 on $200,000 is not enough. You would need $14,000 of annual cash flow to meet that standard. This is how you should think, not emotionally, structurally. Many people think real estate is easy because the idea is simple. Buy house, rent house, collect money. That sentence has destroyed many people. The mechanics are not complicated, but the execution is hard. You have to find the right market. You have to understand rents. You have to understand expenses. You have to underwrite conservatively. You have to manage people. You have to solve problems. You have to know when not to buy. The biggest mistake in real estate is assuming that because something is tangible, it is automatically safe. A bad property is a bad business. It may have walls and land, but if it does not produce adequate cash flow relative to the price and risk, it is not a good investment. It is a responsibility wearing the costume of an asset. The power of real estate comes from several sources. The first is cash flow. If you buy correctly, each property can add income to your life. One property may not replace your paycheck, but a portfolio of good properties can. The second is control. You can improve the property, you can raise rents if the market supports it, you can refinance, you can change management, you can create value in ways you cannot do with a stock ETF. The third is leverage. Real estate allows ordinary people to control a large asset with a smaller amount of equity that can magnify returns when things go well. It can also magnify losses when things go wrong. This is why leverage must be handled with respect. Debt is neither good nor bad by itself. Debt is a tool. Used well, it can increase returns and help you build assets. Used poorly, it can destroy you. The danger is not debt. The danger is debt without margin of safety. The fourth advantage is tax treatment. In many jurisdictions, real estate receives favorable tax treatment because the system recognizes depreciation, operating expenses, and other deductions. In the United States, depreciation can allow a property owner to show less taxable income than the actual cash flow might suggest. That is powerful, but it is also technical. You need a good tax professional. You need to follow the rules. You need to understand that tax benefits do not turn a bad deal into a good deal. A tax deduction is not a reason to buy a weak asset. This is another principle. Do not let the tax tail wag the investment dog. Real estate works best when the underlying economics are sound first and the tax benefits improve what is already a good asset. If the property only works because of an aggressive tax assumption, the property probably does not work. There are also different ways to own real estate. You can buy property yourself. You can invest in someone else's deal. You can participate in a syndication or a crowdfunding structure. The more passive the investment, the more dependent you are on the operator. That means you must underwrite the person, not just the property. In many ways, the operator is the investment. A great operator can turn a difficult property into a profitable one. A bad operator can ruin a good property. This is true in real estate, business, and private credit. People matter, incentives matter, competence matters. So real property can be a major step toward replacing a paycheck. But it is not magic. It requires work, capital, judgment, and risk management. It can be semi-passive, but it is rarely truly passive unless you hire excellent people and are willing to accept lower control in exchange for lower effort. The fourth category is business ownership. This is more advanced because a business is not just an asset. It is a living system. A business has customers, employees, suppliers, competitors, products, margins, cash flow, culture, leadership, and constant problems. Owning a business can be one of the most powerful ways to replace a paycheck because the owner receives the profits after expenses. But profits are not guaranteed. They must be created every day. There is a major difference between being an employee and being an owner. An employee is paid for work. An owner is paid for ownership. That sounds simple, but it changes everything. Suppose a business produces $1 million in revenue. Suppose it has $600,000 in expenses. That leaves $400,000 in profit. Who receives that profit? The owners, the people who own the equity. That is the attraction. Ownership gives you a claim on the residual, but the residual is what remains after everyone else is paid. Employees are paid first, vendors are paid, rent is paid, software is paid, taxes are paid, debt service is paid. Only then does the owner receive what is left. That is why business ownership can be very rewarding and very painful. The owner gets the upside, but the owner also absorbs the uncertainty. There are two broad ways to approach this. You can start a business, or you can buy a business. Starting a business can be rewarding, but it is difficult. Most businesses fail because they underestimate the difficulty of acquiring customers, managing costs, building systems, and surviving long enough to improve. The internet has made business look easy. People talk about buying laundromats, car washes, agencies, stores, and online businesses as if they are simple money machines. They are not. Every business is a machine, and machines break. Customers leave, employees quit, competitors copy, costs rise, regulations change, demand shifts, technology disrupts. If you do not understand the machine, you should not buy it. Buying a business can be attractive because you are buying an existing cash flow rather than starting from zero. But that cash flow must be examined very carefully. You must know whether the profit is real. You must know whether the owner is essential to the business. You must know whether customers are loyal to the business or to the previous owner. You must know whether employees will stay. You must know whether revenue is concentrated in a few customers. You must know whether expenses have been understated. You must know whether deferred maintenance or hidden liabilities exist. A small business can look profitable until you remove the owner. Many businesses are not businesses, they are jobs disguised as businesses. If the owner has to work every day for the income to exist, then you are not buying passive income, you are buying yourself a job. That may be fine if you want to operate it, but do not confuse it with freedom. The highest quality business income comes from systems that can operate without you. That usually requires management, processes, repeat customers, strong margins, and enough scale to hire people who can run the operation. That often requires more capital. Truly passive business ownership is usually expensive because other buyers also want it. If the business is cheap, there is usually a reason. This does not mean you should avoid businesses. It means you should respect them. Business ownership is one of the greatest wealth. building forces in the world because it allows you to build something that can grow, compound, and produce income. But it requires judgment and effort, and if you are not willing to do the work, the business will show you. This is a pattern I have seen throughout my life. People want the outcome without the process. They want the distribution without the discipline. They want the cash flow without the complexity. Reality does not work that way. A good business can replace a paycheck many times over. A bad business can consume your savings, your time, your sleep, and your confidence. The difference is not luck. It is understanding the system before you buy or build it. The fifth category is private credit or peer-to-peer lending. This is where you lend money not to the government, but to individuals, businesses, real estate operators, or other borrowers who need capital in exchange. They pay you interest. Sometimes the interest rates can be much higher than treasuries or dividend yields. That higher income can look attractive. But the first principle is simple. Higher yield usually means higher risk. If someone is paying you 10, 12, 15, or 20% to borrow money, you must ask why. They are not doing it because they want to give you a gift. They are doing it because they need capital and either cannot get it cheaper, need it quickly, or are using it for a project that can support that cost. Sometimes that can be legitimate. Real estate investors often borrow hard money at high rates because they need speed, flexibility, and short-term capital. If the project is sound and the collateral is strong, the lender can earn attractive income. But if the borrower defaults, you need a way to recover capital. That is why collateral matters. I would be extremely careful about unsecured lending. If there is no collateral, then your protection depends almost entirely on the borrower's willingness and ability to pay. If things go wrong, you may have little leverage. If the loan is backed by real estate equipment, receivables, or some other asset, you at least have a claim. But even collateral is not perfect. The collateral may be worth less than expected. It may be hard to sell. Legal enforcement may take time. The borrower may have other creditors ahead of you. The documents may be weak. The market may change. Private credit is not simple just because the concept is simple. The concept is lending money. The reality is underwriting credit. You must understand the borrower, the collateral, the loan to value ratio, the cash flow, the legal structure, the term, the seniority, the exit plan, and the downside scenario. If you do not understand those, you are not investing. You are hoping peer-to-peer platforms can make access easier, but easier access does not remove risk. In fact, ease can be dangerous because it makes risky behavior feel normal. A platform may connect you with borrowers, but you still need to understand what you own. Who is the borrower? What happens if they do not pay? How diversified are you? What fees are being taken? What is the default history? What happens in a recession? What happens if the platform itself has problems? Private credit can be a useful income stream for sophisticated investors. It can produce meaningful cash flow. It can diversify income away from public markets, but it should be approached carefully, slowly, and with a clear understanding that income is compensation for risk. Now let us step back and look at the whole picture. If you want to replace your paycheck, you are not really asking, what is the best investment? You are asking, how do I build a machine that produces cash flow in a way that I can live with? That machine may include treasuries for stability. It may include dividend ETFs for diversified ownership income. It may include real estate for cash flow, tax advantages, and hard assets. It may include business ownership for higher upside and direct control. It may include private credit for additional yield if you understand the risks. The mistake is to think of these as isolated tips. They are not tips. They are parts of a system. The right mix depends on your age, your capital, your spending, your risk tolerance, your taxes, your skills, your time, and your temperament. Temperament may matter more than people think. Some people should not own rental property because they will panic every time something breaks. Some people should not own businesses because uncertainty will consume them. Some people should not chase private credit because high yield will make them ignore downside risk. Some people should not own only treasuries because they will slowly lose purchasing power and not realize it until it is too late. You have to know yourself. That is one of the most important investing principles. A good strategy for someone else can be a bad strategy for you if you cannot follow it. The best portfolio is not the one that looks most intelligent on paper. It is the one that fits your reality and survives stress. Replacing a paycheck requires three things. You need capital, you need assets, you need discipline. Capital comes from earning more than you spend. That is basic, but most people skip it because it is uncomfortable. If you spend everything you earn, you have no seed to plant. You can talk about passive income forever, but without capital, the machine cannot start. Assets are where the capital goes, but not all assets are equal. Some produce income, some produce growth, some preserve liquidity, some require work, some require knowledge. You need to know the job each asset is supposed to do. Discipline is what keeps you from destroying the machine. It keeps you from reaching for yield. It keeps you from buying things you do not understand. It keeps you from selling good assets in a panic. It keeps you from using debt carelessly. It keeps you from confusing a story with a plan. Most people fail not because they cannot find investments. They fail because they do not build a system around the investments. They buy something that pays income, then they spend all the income. They buy real estate, but they do not reserve for repairs. They buy a business, but they underestimate the work. They buy a dividend fund, but they do not understand the underlying assets. They lend money privately, but they do not understand default risk. Then they say investing does not work. Investing works when the principles are right and the behavior is consistent. Let me be clear about the math. If you want $80,000 a year of income, you need a lot of capital unless you are willing to take a lot of risk or do a lot of work. At a 4% yield, $80,000 requires $2 million of invested capital. At a 5% yield, it requires $1.6 million. At an 8% yield, it requires $1 million. But the higher the yield, the more carefully you must examine the risk. This is why people look for shortcuts. They do not like the math. But the math is reality. You can change the equation in only a few ways. You can save more, you can earn more, you can spend less, you can accept more risk, you can do more work, you can take more time, or you can combine several of those. That is the honest version. If someone tells you that you can replace a full paycheck quickly, safely, and passively with very little capital, they are probably selling you something. Real income investing is slower, it is more boring, it is more disciplined, but it is also more real. The goal is not to stop working because work is bad. Work can be meaningful. The goal is to stop being forced to work because every bill depends on your next paycheck. That is a very different thing. When your assets produce income, your choices expand. You can work because you want to, not because you have to. You can take a lower paying opportunity that gives you a better life. You can leave a bad job. You can help your family. You can endure recessions more calmly. You can make decisions from strength instead of fear. That is what income assets are really buying. They are buying optionality, but optionality must be earned. It is built one decision at a time. It is built when you do not spend every raise. It is built when you buy assets instead of liabilities. It is built when you choose a boring treasury over a speculative promise. It is built when you understand the difference between a dividend and a sustainable dividend. It is built when you walk away from a real estate deal because the numbers do not work. It is built when you refuse to buy a business you do not understand. It is built when you demand collateral before lending private money. The world rewards people who understand risk, not people who avoid it completely. Avoiding all risk creates a different risk. The risk that inflation and time slowly erode your life. But blindly accepting risk creates the risk of permanent loss. The art is understanding which risks are worth taking, in what size and under what conditions. That is why a balanced income system matters. Treasuries can help you sleep dividend. ETFs can give you broad ownership income. Real estate can create cash flow and tax efficiency. Businesses can create high upside if you have the skill and temperament. Private credit can add yield if the underwriting is sound. Each has a place, each has a cost. The person who succeeds is not the person who picks the one perfect asset. The person who succeeds is the person who builds the right mix, keeps improving it, and does not blow up. I also want to say something about sacrifice because people do not like this part. You cannot build income assets if every dollar is consumed by lifestyle. Many people do not have an income problem at first. They have a gap problem. The gap is the difference between what they earn and what they spend. That gap is where freedom is born. If the gap is small, the machine grows slowly. If the gap is large, the machine grows faster. This is not a moral judgment. It is arithmetic. You can increase the gap by earning more. You can increase it by spending less. Ideally, you do both. But the key is that the surplus must be converted into assets, not parked permanently in consumption, not used to impress people, not wasted because you feel you deserve it. You do deserve a good life. But the question is, do you want the appearance of a good life now or the structure of a good life later? That is the trade-off. A paycheck gives you immediate cash flow. Assets give you delayed freedom. In the beginning, the paycheck is stronger. The assets feel small. The income they produce feels almost meaningless. A few dollars of interest, a small dividend, one rental payment, a modest business distribution. It does not feel like freedom. But systems compound. The first dollars are the hardest because they look insignificant. Then they become hundreds, then thousands. Then eventually the income from the assets begins to pay for meaningful parts of your life. A bill, a trip, a mortgage payment, a month of expenses, then more. At some point, the machine that looked weak becomes strong. That is how financial independence usually happens. Not suddenly, gradually, then obviously, but only if you protect the machine. You protect it by diversifying. You protect it by keeping cash reserves. You protect it by not using too much debt. You protect it by not chasing yield. You protect it by reinvesting when you can. You protect it by learning. You protect it by recognizing that every asset class has good versions and bad versions. A treasury ladder can be intelligent or poorly matched to your liquidity needs. A dividend ETF can be high quality or a yield trap. A rental property can be a cash flowing asset or an expensive headache. A business can be a wealth engine or a full-time crisis. A private loan can be secured income or a lawsuit waiting to happen. The category does not make the investment good. The structure makes it good. That is the principle. So if I were thinking about replacing a paycheck, I would not ask which one of these assets should I buy. I would ask, what job do I need each asset to do? What money needs to be stable? What money needs to grow? What money can be illiquid? What income can fluctuate? What risks can I emotionally and financially tolerate? What taxes apply? What skills do I have? What do I need to learn before putting serious capital at risk? Those questions will save you more money than any stock tip, and I would build slowly. There is no need to rush into complexity. You can start with the simplest things. Learn how interest works. Learn how dividend funds work. Learn how to read fund holdings. Learn how real estate cash flow is calculated. Learn how businesses generate profit. Learn how credit risk is underwritten. Then move up only when you understand the next layer. Most financial disasters come from people climbing complexity before they have built competence. They start with private lending before they understand credit. They buy a business before they understand accounting. They buy rental property before they understand expenses. They buy high dividend funds before they understand payout sustainability. Do not do that. Move deliberately. A good investor is not in a hurry. A good investor wants the right deal at the right size with the right margin of safety. A good investor knows that missing a deal is not fatal. Losing permanent capital is. If you take nothing else from this, take this. Replacing a paycheck is not about finding income. It is about building durable income. The word durable is the key. Income that disappears during stress is not the income you should build your life around. Income that forces you to sell assets in a downturn is fragile. Income that depends on one tenant, one customer, one borrower, one company, or one platform is fragile. Income that you do not understand is fragile. Durable income is supported by quality assets, strong structures, reasonable leverage, diversification, documentation, and good behavior. That is what you want. You want assets that can support you through cycles, interest rate cycles, inflation cycles, recession cycles, market cycles, real estate cycles, credit cycles, business cycles. The world moves in cycles because human behavior moves in cycles. People become optimistic. They borrow too much. They overpay. Conditions tighten. Weak hands fail. Assets reprice. Strong hands buy. The cycle begins again. If you understand that, you do not panic when conditions change. You adjust. When interest rates are high, treasuries may become more attractive. When rates fall, some real estate and dividend assets may become more attractive. When markets sell off, quality businesses may become cheaper. When credit is tight, private lending may offer higher yields, but only if collateral is strong and underwriting is disciplined. When businesses are mismanaged, operators with skill can create value. The opportunity changes, the principles do not. That is why the real asset is your understanding. The 5 assets are tools, treasuries, dividend ETFs, real estate, businesses, private credit. But a tool in the wrong hands can do damage. A tool in the right hands can build freedom. So do not ask, which asset makes me rich fastest? Ask, which asset can I understand deeply enough to own responsibly? Ask, which asset fits my system? Ask, which asset helps me replace a paycheck without creating a risk that can wipe me out? That is how I would think about it. The end goal is simple. You want your money to work when you are not working. You want income that is not tied to your alarm clock. You want assets that pay you because you provided capital, solved a problem, accepted a risk, or owned a productive machine. But the path is not magic. It starts with surplus, it continues with education, it compounds through discipline, it survives through risk management. And over time, if you keep doing those things, the relationship between your labor and your life changes. At first, you work for every dollar. Then your dollars start working beside you. Then one day, if you have built the system carefully enough, your assets carry more of the weight than your labor does. That is the moment people call freedom. But it is not luck. It is not a secret. It is not a trick. It is capital placed into productive or income. Generating assets governed by principles, protected from foolish behavior and given enough time to compound. That is the game. And the sooner you understand the game, the sooner you can stop depending entirely on the next paycheck and start building the machine that may one day replace it.